So we're back for another episode of the Property Now podcast. I'm your host, Michael Carbone. My friends call me Carbs. I've got a few friends with me here
for various reasons.
Yeah, well, there's two good reasons. Anyway, I'll leave that to your own imagination and judgment. But today, normally we talk about residential property, issues, problems, news, which makes a lot of sense. But today I'm really excited because we're talking in a different area. We're talking commercial property. I don't know a lot about it. I want to learn about it because I want to buy a commercial property at some point. That's my next plan in an SMSF, maybe. We'll talk about that later. But I've got the experts here with me. So I want to start with, to my left, Director at RRW Capital, Mr. Dan Millar. Welcome, mate.
Thanks for having me, Michael.
You guys obviously fund a lot of projects, and commercial space is something that you guys are looking more and more into. So it makes a lot of sense to be having this chat with you today.
Yeah, absolutely. Yeah, we're a funds management business, and we do debt and we do equity. So Brenton from Hannas and the Hannas Group are joint venture partners on a couple of industrial projects.
Great.
So we like the asset class and we know it well. Not as well as the Hannas Group, but yeah, we're familiar with it. So we've got some equity projects in industrial, and also we lend into them as well with some of our borrowers in the same sort of space as well.
Lovely. Well, you mentioned Brenton, so I'll introduce you next, mate. The man with the mo. I love the mustache, man. I wish I could pull it off.
He gets a lot of comments,
sales manager at Hannas, obviously across a number of projects. We're very proud to be partnering with Hannas on a few projects as well.
Yeah, we were excited to join Co-Posit and assist with that buyer transition from being interested but may not having the capacity for the deposit up front. We've found it beneficial, and look, at this stage we'd look to continue the relationship moving forward, and we'd have projects from start to end.
Well, that's great. That's all recorded, Pete, so we can clip that one.
That's on record.
I just think because we came in a bit late, right? We got approached and we sort of had that last 12 months, 9 to 12 months, but we've seen the benefits of it.
Yeah, great.
But
obviously the more time the better. But what I love is you guys were our first real commercial sort of play and partner. We're seeing a lot of interest already in that space because everyone saw us as resi only. But all of a sudden, hey, there's another option here. There's another property type. And we saw a lot of interest on our side. So really proud to have you here, and looking forward to it. We can unpack the projects a little bit more later on down the track as well, but that'll be fantastic. Now, I needed a mortgage broker on this conversation as well, because obviously there are differences between, I think not everyone understands resi finance, but they would probably understand it more than they might commercial, and there are some differences. So I needed a pro to help me unpack that.
A pro? Wow.
Well, have you been called a pro before, Joe? No. So Joe Daoud,
yes.
I'm going to call you Joe because I feel like we're friends now. I'm not going to call you Joseph. From It's Simple. So welcome, mate. Thank you for taking the call.
Thank you so much for having me on, Carbs. I really appreciate it.
See, I like what you did there. We're already friends. That's great. Congrats on the little baby. I hope you don't mind me saying.
Oh, man, he's an absolute rocket. He's. I promise you, there are some days where, you're stressed out. We all work in property. We all work in finance. We understand that there's stressful days. But you come home, grab him, he starts laughing at you. It's like medicine. And that's the best way to explain it. So, yeah, it's the best thing in the world.
I love it when people talk positively about the 10-week-old phase. No, seriously, because everyone's like, oh, it's hard, you don't sleep. But you don't hear about the good stuff. You get home. I think he's probably starting to recognise you now, right? Yes. So you'll get home, he's like, this is my dad, I know this guy. And it just makes it so much, but it's amazing. Makes it worthwhile.
We could spend a whole pod talking about being a new dad. I'll tell you that.
We'll do that next time. We'll do that next time. We'll do that next time.
You'd have to do a series on it.
But it certainly makes you like, I have no doubt, like looking at what you've done and achieved, that it's simple. And this is way off topic, but you're obviously hungry, you got drive, good operator. But once you add children into the mix, you just take it up to that next level.
It's surprising once the baby comes along, you really recognise what is an opportunity and what isn't, because you need to dedicate your time accordingly. And what I've noticed is an increase in inefficiency. So not inefficiency.
Inefficiency. Yeah.
But so it's actually been great on that side as well.
Oh, congrats, man. That's awesome.
Thank you.
Let's bring it back to the topic, commercial property. Basic question, what is it? What's commercial? What is considered commercial? Who wants to field the first one?
I'll jump in.
Yeah.
So I suppose commercial real estate can be quite broad. So it can cover in my view, like multiple asset classes. I'm sure Joe would agree with me. So obviously industrial, and then there's little subsets within industrial. You got the big box stuff like the Macquarie Goodmans, the big logistics centres, and then you've got the smaller stuff, the industrial strata projects, which we're active in with the Hannas Group. You've got your conventional commercial office that can be big, small little corner office, can range from values as well, and then retail, shopping centres. You can get strip retail.
Restaurants, cafes,
anything that's got like a retail lease attached to it is a retail property. And then, you could sort of cast a net even wider. I'd even put like pubs in there as like sort of operating commercial assets. So basically any property that's non-residential really can be sort of captured, in my mind, as commercial.
It really depends, though, on what the bank is also defining as a residential or a commercial asset. So you can look at hotels where people stay for, multiple nights at a time, or service apartments. A lot of the time they could also be considered as a commercial property. So if you're looking at a 4-story hotel, which consists of 60 keys, that's a commercial property. Okay. So it really depends on what the bank's definition of it is, as well as what the intended value, the intended use of the property is. Because if let's say, for instance, you have a residential property that has been carved out into a podcast studio, okay? Or give you an example, we had a house that's been turned into a surgeon's clinic. The bank struggled to define that. Initially, it was classed as a residential property, but because they've gone in and they've turned all the rooms into different medical offices, that's the issue. So it really depends on what the value are and what the bank is defining as a commercial property at the time.
I never considered that, because sometimes you see like there might be like an office scenario or a shop scenario at the front and then someone's living out the back. Mm-hmm. So is that like, what is that?
It really depends on how the bank defines it. Is it 2 separate titles? Have they subdivided it? It really, really depends. So commercial property is, as you said, quite broad, but layman's terms, when most people are thinking, it's usually your retail, your restaurants, your shopping centres, your offices, and your industrial.
Yep. From a capital perspective, Dan, like what's making commercial, and I know it is very broad, so maybe we start to segment, but what's making it so attractive?
Yeah, I think like just from a pure investment perspective, like if you're looking to buy a commercial property, I'm sure Joe would agree with me that the yields like are far more attractive than buying a residential apartment as an investment, which can, typically get 3 or 4% gross yield, whereas a commercial property, depending what commercial property type it is, can get sort of 5 to 7%. So, your return on your money is superior. And we're also seeing some capital growth prospects in commercial property as interest rates are lowering. There's more capital in the market, which is actually also sort of adding to some capital growth. So I think commercial real estate is starting to be more attractive, even for just sort of simple private investors, and also your big players in town as well, who are sort of expert, sort of sophisticated investment houses as well.
What is the reason for that yield, the greater yield, do you think?
I think... Jump in, Joe, if you've got a view on this. I think, with commercial real estate, there is inherent sort of risk that you don't really necessarily get with residential rental properties. Like if you have a rental apartment and your tenant leaves, you can normally get a tenant in there in a couple of weeks, right? Because the resi market's so hot for leasing. However, if you have a commercial property and you have like a 3-year tenant and then they pack up shop and leave, it might take you 3-6 months to find a new tenant. And obviously in that period of time, you're not sort of generating any cash flow on the asset. So the yields kind of reflect that sort of risk and security side of things for your investment returns.
I guess we've established as well, there's so many different types of commercial. So you might be set up to run a kitchen, a restaurant or a cafe. That limits you to restaurant and cafe tenants.
That's right.
So whereas so there's probably a whole heap of things to unpack there as well. From an industrial perspective, because that's where, the Hannas bread and butter at the moment with you, Brenton. What are you seeing in terms of like buyers? Like, is it operators of the business that are looking to purchase properties, or is it investors, or is it a real mix? Like, how's that sort of look?
I mean, in terms of the projects and market at the moment, we're actually heavily in favour of investors. We're probably 80-20%. That does tend to even itself out as you get closer to completion and occupiers may be nearing lease expiries and they need an immediate option. we probably don't perceive that getting to 50-50, but, you know, on Rockwater Brookvale and our Northmead project, we'll probably see that at, say, 70-30. That's 70% investors. And look, if I'm honest, they're all kind of, a lot of the early investors are high wealth people that have got, you know, decent business acumen. They've invested in property before. They've got their resi. They're now looking at the cash flow assets in commercial. Those tend to be the first buyers that come through. They sort of lap it up, you know, sign the contracts, and then they kind of, you know, we work with them on potential yields in the future, rental returns. But yeah, I mean, it's interesting because everybody, you know, you get taught, you know, buy your first residential, you know, it's a good investment. You'll get the capital growth side and you'll get a bit of a yield. But like Dan mentioned before, 3.8% gross, which for people that may not know gross, that means that's income that's come in before you subtract your expenses. Yeah. So industrial, the tenant, you know, in our industrial space, the tenants are paying the outgoings. So you're getting a net yield at, say, a very tight one. It might be around, say, 4.5. But then a sort of market yield at the moment, probably around 5.5 in industrial. And then Dan touched on it as well. You might be getting higher in certain, you know, office or retail assets. But the reason you're probably in that high yield is because there's been a massive shift for a lot of, especially retail style businesses where they do a lot of it online. So e-commerce has become a real thing for businesses to cut that retail expense. So you're getting a lot of those now moving into industrial properties, which is slightly tighten that yield. There's more interest. There's more investors getting amongst it. But that interest and tighter yield, to me, it's not a massive deterrent because it's showing that it's a competitive asset. You know, people that have the acumen understanding of it are trying to invest in these assets because they see the future of industrial as very positive.
I just see more and more industrial, and you probably touched on it from a retail perspective.
Yep.
Shops are probably more, people go to shops for entertainment now.
Yep.
Or just for a Sunday, somewhere to take the kids. But you got to store, e-commerce has just changed everything.
Yep.
Amazon, you got to store the stuff somewhere.
And retail rates are high. Like if you're getting something with exposure, you're paying a premium rate on your retail. A lot of that's now just going online. You're paying for your website and your marketing, which you'd pay the marketing anyway. And they just need the box to store the product. And with industrial, you can still showroom it. You know, if you've got an ancillary showroom component, but the majority of it sort of been for warehouse storage, you've still got that ability to showroom it. You know, put a studio in there, take some photos of it, put it online. But because you're sort of getting rid of that retail piece in terms of your leasing, we've just found that the vacancy rates in Sydney have been very tight probably for the last 3 to 4 years. And a big factor was COVID.
It's super interesting. We'll touch on COVID as well because definitely, especially in the office space, that's been a massive thing. And it feels like so long ago now, COVID, but there's still lasting effects. But I always find it funny with industrial, people refer to it as boxes. You guys have both referred to it as boxes today.
It's shells.
I've heard
fancy
sheds.
boxes.
People say sheds. I look at all these sheds going up in Eastern and what have you.
Agents love to use sheds.
They do use sheds a lot, right? But and it almost seems like a boring investment or product.
Yeah.
But like when you talk about yields and how it's actually simple.
It's very simple, and simple means less can go wrong. And in terms of Hannas, like one of the reasons we like industrial is because it's very hard to, you can get it wrong in terms of your design, but in terms of the actual asset and the finished product, there's a lot less that can go wrong with it.
Yeah.
You know, resi as anyone that's got a resi investment, you've always got tenant issues, fixing sinks, maintenance on the asset, walls, I don't know, power points, all that sort of stuff. An industrial asset very much is for concrete precast floors, concrete slab. Yeah,
that's right. I hear when you say, "Oh, it's boring." Like, yeah, okay, give me boring. That's easy. Or just let it be, sit there,
but it doesn't
make
even
some
have
money.
To. They can look beautiful from the outside.
This is what I was trying to get. Yeah,
and that's kind of Hannas' piece is that where was the gap in the industrial market? Because there's some very good developers out there doing great product.
Yeah,
and it was kind of that higher end. You know, why can't we make it a place where people want to go, as opposed to, you know, chucking them somewhere out west in an old shed and being like, this is where you're working from. Why not glorify it? Why not, you know, scrub it up, make it look tidy?
And there's more and more. Like you drive out to Eastern Creek, Badgerys Creek, like the airport's happening. It's just sheds as far as the eye can see in some areas. And there's obviously a need for it as well. But I love the fact that it's not where people are, like yourselves, considering how these things look. Like you want them to look nice. You don't want it to be rusty old sheds.
Yeah, you're targeting like the gentrified markets where there's that immediate demand, and there's some very tidy users that rely heavily on the bringing customers to their warehouse or having staff working from a warehouse, because the warehouse units we sell, for example, have an office in it.
Yep.
So you're getting an office and a warehouse unit, and they want it to present well for customers. So we're like, well, there's not, especially in a market like Brookvale, there wasn't a lot of that high-end product. A lot of them had leaky roofs, low ceilings, old, a little bit haggard kind of assets.
Yep.
So we're like, well, why don't we, Northern Beaches is an up marketplace. Why don't we just create a beautiful product, create a community where people want to come?
It's a good spot. We're there last week. Looking good.
It was good to have you on site.
Fantastic.
Yeah, bacon and egg roll.
Yeah, the bacon and egg roll is my
That's where the
favourite
carbs
part.
are.
That's the carbs part. You touched on the buyer breakdown, and I want to get Joe's opinion actually as well, because you said something really interesting. People they're more sophisticated investors that start to look at industrial because they think, oh yeah, I buy a resi, I buy another resi. What else can I do? Do you see this often, Joe? Is it people that own a couple of resi properties that get into commercial, or can people is it more common for people to start with a commercial property now as an investment?
It's quite a funny market. The indication from September, last month that just passed, what we noticed was a lot of people are stepping into the commercial space, industrial space, because there's not enough supply on the residential side of it. So with the residential market, we've seen property in Sydney inflate, I think it's almost 12.1%, and that's across dwellings. That's just not houses, that's houses and apartments all across Sydney. But then you look at something like industrial, you look at commercial warehouses, you look at the old sheds, and they're still growing at that rate. But what there's less competition when you're going to market. And the rental yields are actually better once you include, certain things like strata. Yeah. Mm-hmm. Once you include quite a few things like your council rates, all those sorts of things. There's a massive advantage to purchasing commercial or industrial. What we are noticing, however, is people are going into their super to be able to purchase it, because they look at this asset, they see that it's positively yielding, you're not paying in excess, and then on top of that, the capital gain is almost on par with the residential side. So people are making the smart investment choices where they're not depending on a fund to be able to grow their asset, but rather they're depending on an asset, a tangible asset, brick and mortar, to be able to grow their retirement fund. And they're looking a lot more into the commercial market.
So more people using a self-managed super fund to get into commercial?
Correct. And on top of that, we are having banks now diversify their product, their product matrix to include self-managed super fund loans, to include using your super to purchase a commercial property. Previously, there weren't many lenders in the market in that space, but now you're starting to see a lot more get into it.
And that just means there's an appetite for it, right? If the banks are responding in that way, it means people are asking the question. I'm asking the question. I'm happy to get personal. I'm looking at setting up an SMSF so that I can buy a commercial property in super. To me, it makes sense, and I want to unpack this with you a little bit. But so obviously, it's the intricacies of setting up an SMSF. We've done a whole episode on that, so go back and watch that. But once you've set that up, the financing model for commercial is a little bit different to resi in that you probably need a higher deposit.
So your deposit, you're looking at around 30%. It really depends where the security is. If you're looking to purchase a commercial asset out in Whoop, Queensland, okay, you might need a 50% deposit. But if you're looking for something Sydney Metro, or if you're going all along the South Coast, if you're going all the way down to Wollongong, if you're in certain logistics centres, you might be able to get a higher LVR, or you might be able to use a lower deposit. It really depends on where you're looking, but what you need to note is, especially when it's your SMSF, there's no negative gearing included. There's no, we're going to give an add back on the tax. You have to always look at just your outgoings and if the rent will be able to cover whatever the loan is going to be. And then you can add the personal contributions on top of that as well, whether it's via a personal guarantee or it's income verification, depending on which lender you're going to. So when you ask me the question, how much of a deposit do I need? It's a very long-winded question. However, always expect, when it comes to commercial property, expect about 30%. when you're looking to purchase something in your super, very rarely will I ever see anything less than a 30% deposit.
Yeah, which makes sense. So do you need, in that scenario, would you need the rent to cover the repayments, or does your contributions?
If you're purchasing in your SMSF,
Yep.
then yes, you do. You need your rent to be able to cover it. And then on top of that, your superannuation contributions also to be able to cover it.
Yep.
And then if you want to make extra voluntary contribution to your super, you can, but then we need to, do a whole assessment and everything and just make sure that you're able to meet those demands.
Yeah, great. What are the differences in resi lending versus commercial lending that someone might? Yeah,
How long do I have?
That's a massive question, isn't it? When I ask that, you're like, whoa, okay. But like, what are some of the main things that, if I came to you and said, Joe, looking at a commercial property, what would surprise me as a potential buyer that would be so different?
Is there a lease in place? That's the first question I'm going to ask. Are you an owner occupied? Are you going to be running your business from it? Yeah. If you're a retail individual, and what I mean by retail is you're working for someone else, you're an employee of someone else, and you're coming to me, I'm looking at this, and first thing I'm automatically thinking is there a lease in place? Because you need a tenant in there. You're not going to be operating from there. Yeah. However, if you are a business owner and you're going to be operating from that location, and let's say you have been operating from that location and it's come up on market for you to be able to purchase, okay, that's where we're looking at a lender like Judo, because we can go off the owner-occupied lease. We'll look at the financials. We'll see that you've paid this much. That's how much you're going to be able to contribute towards this, towards the mortgage. It really does depend on the individual and what they're looking to achieve. Something that you might ask that would come up that would surprise me is, or something I might ask that would surprise is, are you prepared to pay for the valuation? So a lot of resi customers are used to desktop valuations, short form valuations, and the bank being able to cover it. When it comes to any type of commercial property, you always need to send a valuer out. There's a panel of lenders, and the reason why is each property is unique. When you're purchasing something resi, there's so much in the market. It's 3 bedrooms, 2 bathrooms, 2 car spots in, I'm trying to think of a suburb, Padstow. That's close to me. That's the reason why I came up. You look at the market, you look at the comparables, you see, okay, yep, this is what the rough estimate's going to be. We're happy to lend 80% based on that. That's how the desktop valuations usually work. But then when it comes to a commercial asset, something could be 50 square meters and you could have 2 shops next to each other, both are 50 square meters. One is a restaurant, one is a laundromat. Restaurant has grease traps, range hoods, it's got a kitchen in there, you've got to make sure that it's got bathrooms. There's a whole bunch of requirements needed in order to be able to open up a restaurant. On the other side of it is a laundromat. What do you need? You might need some special plumbing, but that's it. So you need to send the valuer out because each property is unique. The assets within that restaurant is what is going to build the valuation up. They could both sell. They could both sell tomorrow, but because the restaurant is in there, everyone knows that it's got all the equipment, that could go for $250,000 more, or the valuation could be $250,000 more. So really, you asking me a question as a customer, are you prepared to pay for the valuation? The valuation is going to be this much. It's going to
what's the cost? Is it different depending on where?
It's different depending on the asset, the size, where it is, how many valuers are willing to approach it. It could range anywhere between $1,000 all the way up to, $15,000, $20,000. It really depends on what the asset is.
Okay.
We've seen a $20,000 valuation come up, and that was for a ski lodge that we recently refinanced. That was a fun one.
Look, if I'm buying
don't man. It was that was a lot of fun. But
don't buy a ski lodge.
If I'm buying a ski lodge,
don't value it.
I'm sure I can pay $20,000 for a valuation if that's what I'm doing. If that's what I'm in the market for. But it's an interesting point, right? Because I think if I'm in the market for a resi property and I know my suburb and I'm on REA every day, then I could walk past a for sale sign and go, yeah, I reckon that's worth whatever. I would know within 100K what it's worth. But for industrial or for commercial, that's different. You're right. I don't know what's inside just by walking past. So it does make it very tricky. And if you're going to a bank or to a lender, will it you said the lease needs to be in place. What if the lease is not in place? What happens then? Does that mean you can borrow less or your budget becomes less? What's the answer there?
It really depends on the asset, the total value of the asset, what the vacancy rates are. You're asking me a very long-winded question there because first thing I'm asking, is there a lease in place? Why? How long is it going to be on the market for? Do you have enough to be able to contribute the interest repayments or the principal and interest repayments in that time for you to be able to find a tenant? Do you need to pay for the fit out? Yeah. There's so many things involved when you become a landlord. The reason we ask, is there a lease in place, is that is dependable income. That is something that is guaranteed. It's coming in. The person is selling this asset because it's on its capital growth. They're happy with the money. They're 65 years old and they want to retire and enjoy their lives. Okay, it's come up on the market. There's a 5+5+5, which in least, yeah, you know what I'm saying. There's a 5+5+5. They're in year 2 of the first stage. They could see this is how much the increase is every year, usually follow CPI, but that's something we could depend on as the income. If that is not in place, then they're going off the valuer's assessment, and that could go off price per square meter, it could go off comparables in the market. There's so many things that are involved, and that's the reason why valuations are so important when it comes to purchasing commercial property.
If we're comparing commercial to resi again, would I, as an individual going to look at resi or commercial, would I have a different borrowing capacity?
Yes.
So how would that work?
It depends on how you set up your asset. Yeah. It depends on what entity you're purchasing in. If you're borrowing as an individual and you're purchasing a commercial asset, what is backing it? And it also depends on the personal liabilities or the things that are in your personal name. If you're an individual, you've set up an SPV, you set up a trust. This is not advice in any ways. Please speak to your accountant before doing anything like this. But if you're setting up an SPV,
just out of interest, what's an SPV?
Special purpose vehicle,
standalone company.
Yeah,
new company.
Yeah. So we're using its trust to essentially be used to be able to purchase a property, and what that trust is basically limits the personal liability of the individual, but at the same time it acts as me as an individual, I would be the beneficiary of that trust. So any profits or anything would then trickle down to me. Yet again, speak to your accountant before going ahead and trying to set up anything like this. But you as an individual, if you're looking to purchase this, you purchase it in an SPV. Well, if you're approaching lenders like Latrobe, Think Tank, I'm trying to think of other ones on the market, Liberty, where you can do low doc, you might actually have a higher borrowing capacity, because if your accountant can confirm that you can meet the repayments and on top of that you have the necessary income in order to be able to pay for that loan, then that's okay. But if you're approaching a lender, your tier 1 lenders like your NABs, your CBAs, US PACs, they have different policies across the market. So you have to be very careful when approaching commercial property, but it's also why you need to speak to a broker, shameless plug, before you go and do anything like that.
I was going to say that. I was going to say a lot of people stick with the bank they know, but it may not be the best bank for commercial. And like, you know, when we speak to brokers and we say, no, have a chat to this guy because you might be with this bank, but he's probably got a better package for you with a different bank, and they might class each different asset type as more secure.
I've got a great example. We settled on a property earlier this year. It was a $3 million factory over in Milpara. It was a lease stock application. We went through the whole process, new lease coming in place. Because of the policy not being clear, they needed the lease that was in place. That was the income that they were depending on when it comes to a lease stock application. I know I'm going to get a question on the lease stock application in a moment. So, but what we did was we went to Think Tank instead, because the new lease was going to be able to cover that. So just because one bank services one way doesn't mean the other bank, or Latrobe's not a bank, they're a third-party lender, kind of non-conforming lender. But because Latrobe didn't service that way, we could always go to Think Tank. And every bank or every lender has their own niche and where they want to operate from when it comes to commercial lending. Columbus Capital, they are probably one of the biggest in the development construction market at the moment for resi houses or for commercial property as well, commercial construction. That's their niche, that's their risk appetite, that's what they're looking into more of. Whilst a lender like Liberty, they don't even do construction, but they want to acquire more assets and they want people to be able to borrow more. They have higher risk fees, they have higher interest rates, but you really need to speak to someone before going ahead and approaching for those starts.
Yeah, I guess you guys have all the banks and financiers at your fingertips. You know who's at what works for what niche. You predicted a question, lease stock. Can you just unpack what that means? Lease stock often depends on ICR. What ICR is the interest coverage ratio.
lease stock loans are they're all interest only. It's not principal and interest. There's no debt service cover. It's dependent on the interest. Does your lease cover the interest repayments required every month? Times a multiplier. So Macquarie apparently now is doing it at 1.1. I'm not 100% sure on that, but I have heard that recently from a very high level broker. But usually your ICR, the ratio that you want to be targeting is 1.2. So let's say my interest repayments every single month are $30,000. My lease is $36,000. That covers the 1.2. So the bank will just tick that off and they'll go, yep, that's a lease stock application. No, that's a lease stock. Yep, that services for a lease stock application. That's all well and good. Depending on which lender you go to as well, you need to have different deposit requirements. So you might require a higher deposit because lease stock to the bank is considered riskier. Yep. You're not taking on a personal guarantee, or you're not using the client's personal income to be able to assess the loan. You're just going based off the lease. So that's how a lease stock application works.
So much to unpack.
I'm sitting there like, whoa, man.
You need a broker before you making any decision.
Because when we put our leases in place, we tend to get, you obviously get your security, your bank guarantee security, 3 to 6 months, but we quite often try and get that personal guarantee as well.
Yeah.
Just to add that extra layer of protection.
Yeah.
Which I'm not sure how that would affect it, but if you saw something with a PG, then potentially you're starting to look at individual income.
It's a much stronger application when the person is willing to. Across 98%, 99% of all applications, we are getting personal guarantees. You do have the odd 1% that, they don't want to give it up, and they'll happily put in another asset from their business or something along the lines of that. However, the personal guarantees is a very, very strong thing.
Yeah, I'm sure.
Are there any questions that someone should ask a broker, in your opinion, before they make that decision?
The broker will probably just clarify everything for them. There's no one model that fits all. Like a lot of people like you and I, we've got this idea in our head that, we might even, I was talking to a guy the other day, he thought he needed 50% on a warehouse. And I was like, no, have a chat to the broker. You'll have several different options to try and work out how much you actually need. But everyone has this one idea of how much, a set idea of, you need 20, you need 30, you need 40, whatever percent. But yeah, like Joey was saying.
We did a lease stock application the other day with a 20% deposit. But that's because the bank knew the client. They had seen how they had operated before and they were comfortable with it.
Yeah.
And he can probably correct me if I'm wrong, but when it comes to the owner-occupiers, if they've got a good profit and loss, their income from the business can service a loan.
Well, that's completely different because you're not paying yourself rent.
So those owner-occupiers.
If you're the owner-occupier.
Well, no. If you are the owner-occupier, you are. If you are operating a business and you're the director of that business, and then the SPV or the trust has purchased the property itself, you are paying.
So if you're under an SMSF scenario, but if
you could do an owner-occupied lease.
Yeah.
It's a related party lease.
Yeah. Co-posit move-in. Exactly. They've got income that pays the mortgage repayments.
Yeah.
I actually saw one the other day, and I'm not sure of the exact interest rate he achieved on it, but because it was a business that had been operating for 20, 30 years, their income, their profit was always solid for the period of their company lifespan. He actually got 100% debt, but I think he had a slightly higher interest rate. And then that comes down to the individual situation. But, you can get 100, but you've got to have good backing.
There's lenders for everything, right? They can lend more, but you'll just have to pay a higher rate, right? There's just a lot of money in the market, and a lot of lenders do like commercial real estate.
Yep.
So, I think, if you have a broker who has good contacts, you can easily place your loan somewhere.
So why do lenders like commercial?
I think, fundamentally, there's just limited supply. Like Joe mentioned, you've got good serviceability. So if you've got a third-party lease that covers interest payments, then that's always a big tick in the sort of credit risk box for lenders. There's just looking to deploy capital, basically. Yeah.
Could I ask Dan a question? Because
you can ask Dan.
Obviously Dan works with international capital as well. And he can probably explain better than me, but we've seen a lot of interest from overseas, America, Asia, different markets looking to heavily invest capital into Australia and especially the industrial space. And I just kind of want to get an understanding of how they perceive industrial and commercial in Australia and why there's such an appetite.
Yeah, so on a macro level, Australia is still very attractive in the old Asia Pacific region, stable politically compared to some other countries, and just strong fundamentals, really. So a lot of the big offshore capital investors and capital providers love Australia. So when they've got like a Asia Pacific allocation, Australia heavily features. And, industrial property itself is deemed, low risk in sort of broad commercial real estate terms versus office, which has been knocked around a lot due to COVID, some of the challenges Brenton touched on at the beginning with retail property and the disruption from e-commerce and all that. So industrial is a bit of a safe house, whether it's a big logistics asset with a long-term lease with a multinational company, that thing's pretty much bulletproof. Yeah. So they like putting their money into that sort of lower risk bucket. They also like putting their money into some more sort of bespoke industrial strata projects as well, because they like the thematic. It's still industrial, but you get better returns, and there's a development aspect to it, so you can make higher returns on your money that you invest. So yeah, I think, in short, Australia is very, very attractive internationally versus other countries for the big end of town.
From a property perspective, obviously, as well, prices, Australian property.
Australian real estate's kind of never gone backwards.
It keeps going.
Like there's ups and downs, but like if you take a 10, 20-year view, no one's gone backwards.
And not to say that's forever. I don't want to give financial advice.
There's some challenges. There's some challenges.
Yeah.
Like leasing challenges can arise with COVID, the office disruption, retail disruption. But fundamentally, those things do level out. And I think the commercial real estate sector is pretty rock solid over a long-term investment horizon.
That's a good question, Brenton. You could be a good co-host. That's very good. That was very
good. Give it a crack, eh?
We mentioned
every Wednesday.
Every Wednesday at this time. Yeah. We mentioned COVID a few times, and I feel like, again, the commercial sector is so diverse, right? Because if you're making a decision to invest commercially, well then, okay, within that, what are you talking about? Are we talking retail? Are we talking industrial? Are we talking office space? And all of those areas were affected differently in COVID. So, there's probably been an industrial boom in COVID because people need to store stuff and there's e-commerce and things moving around, and that makes sense. Whereas, retail, people have predicted the death of retail for a little while now. Even though every shopping centre we go to on the weekend is crazy because people want things to do, you know what I mean? Yeah. But retail has obviously shifted. The big one is obviously office space. There's been a lot of work from home, and the whole dynamic of working from home or from a space has changed. A lot of companies are going back to the office, and I certainly do see a lot of I see a lot of people. This is just a personal thing as well, but I see people that work from home 5 days a week and they're in their trackies and they're just like low on life, and it's like,
I agree.
Maybe there needs to be a balance there, but that's a topic for another day. But obviously, office has seen a hit. For obvious reasons.
Absolutely.
Yeah.
So, there was the COVID shock, and then post-COVID, people did start returning to work, but not everyone was keen to return to work. Like some people do prefer, logging on at home in their tracksuit pants. So what that sort of resulted in was a lot of the big businesses shrunk their office space requirements, and that's across the board. So, what that does is create vacancies. Then landlords are under pressure to fill those vacancies, lifts incentives, fit out contributions. The knock-on effect was massive. What we saw in sort of post-COVID office was a flight to quality as well. So, the old B-grade office building in the city that hasn't been given a facelift for a couple of years with, poor amenities, those office assets were really struggling. The landlords who really invested to get end-of-trip facilities, new kitchens, all that sort of stuff did attract people back into the office. So they sort of outperformed the secondary assets. So that has been a big adjustment in the office sector. But I think, walking around the city, we're in Martin Place. The place is buzzing at the moment. However, if you go to Melbourne's still struggling. Melbourne's a disaster just for office and people sort of coming into the city. So again, very much sort of city dependent. But if I speak to Sydney, it feels like everyone's back in the office 4 or 5 days. So we're kind of come out the end, and hopefully it's green shoots from here for the office space in Sydney.
You laughed at Melbourne, Joe.
No, because we're setting up our second office in Melbourne as we speak. So the price that we're paying down there compared to what we're paying here
For rent?
Yeah,
I was going to say you probably got too many options.
Oh,
That's actually an opportunity, right? That's fantastic.
Yeah,
it's a huge opportunity to be able to purchase because the government is getting involved down there when it comes to the return to work to office. They are trying to make it government legislation to that you work from home 2 days a week.
Yeah, it's crazy.
But then when you look at commercial real estate, well, what does that do to all the office space? All the office space. Everyone wants human connection. Everybody wants to be able to go out. But if we're not giving people reason, or if people don't want to learn via osmosis or anything like that, the commercial real estate in Melbourne has taken a massive hit because of this. The residential market is still performing quite well, but it's just Melbourne's a ghost town when you go to the city. So it's actually crazy. That's the reason why I was laughing.
I'd even say the Melbourne resi market it's been interesting as well. It's now one of once upon a time it was one of the more expensive
Sydney
places.
than Melbourne.
It was Sydney, Melbourne.
Yeah, always.
But I think Brisbane's overtaken.
Even Adelaide's coming close.
overtaken.
Yeah.
Perth's not there yet, but it's
No,
growing.
it could be.
Even places like the Gold Coast, you know what I mean? So Melbourne's interesting from all perspectives, and certainly from an office perspective as well. I mean, they were hit the hardest
With the lockdowns.
during COVID.
Yeah, absolutely.
And they've obviously now they're repairing the slowest. Which
But
is
I
really
think when the
interesting.
government's getting involved and they're getting in between the employer-employee relationship and saying, no, it's legislation, you're going to work from home 2 days a week to win over some votes. Like, let's not beat around the bushes, stay in power. You're impacting small businesses. And small businesses, Australia's been built on small business. It's been built on blue-collar individuals. It's been built on people willing to take risk to be able to purchase these assets or, to take on the tenancies at these office suites. And now we're seeing a complete shift and it's impacting that whole city. Yeah. We need to be able to return into that. I don't want to say incentive-based because people shouldn't be incentive-based to that they should want to work just as it is. But what I'm trying to say is we should not have a government interfering between that relationship.
I always get cranky when governments don't let things happen organically. All right, so let it happen. If there's opportunities to work from home now, if people want to find a job where they need 2 days a week from home, they can find that job. Mm-hmm. But but if the scenario is, hey, this company is 5 days a week, then that's how it is. You know what I mean? And if you're not happy,
it should be up to the
go
business
find
owner.
something, or speak to the owner, or what have you. So I would prefer to see them happen more organically. Where I get the issue for me is also not every industry can work from home. Mm-hmm. All right, if I work in a restaurant, I can't work from home. Mm-hmm. All right, if I'm in entertainment, I can't work from home. If I drive Uber, I can't work from home unless I live in my car. There's a
blurred line.
So who are we trying to appease?
I do want to add one thing.
Yeah.
Work from home gives a big advantage to the larger companies.
Yes.
Why I say that is they have the resources to be able to implement online training courses, modules, take people through step by step. If you are a new business and you're trying to operate and you have to train a new employee from home and you don't, via Teams, and you don't have access to, different learning modules or education systems to be able to teach them, take them through step by step, that person's going to be an underperforming employee. On top of that, you as an employer or you as a business owner, your time is worth money. So you're spending 2-3 hours with somebody on Teams who could have their screen off and, they're just in the corner and they're getting their AI to take notes and they're not going to perform as well. So we're impacting small businesses in a bigger way on that side too. And where you see businesses like I'm just going to use an example, PwC, Macquarie Bank, all the large firms, they have the money to invest in those online modules because they need it. They've got 10,000 people globally working for them. Yeah. So we're seeing the impact on that side as well, where the big businesses have a massive advantage and then the small guys don't. So
can I get personal with you? How many people are in your business?
We're now 10 full-time employees.
10.
Yeah.
What's your policy in terms of office or from home, or is there a balance?
First 3 months is in office 4 days a week.
Yep.
Regardless, you need to be in the office 4 days a week.
Yep.
The reason for that is a lot of what we do is learning via osmosis. Osmosis is when you're just learning.
In the environment,
Being there,
absorbing.
Yeah. We do have our online modules and everything, but you need to work from the office 4 days a week. 1 day a week you get to select. And then after the first 3 months are up, then we figure out, okay, does this person still need to be in the office 4 days a week? Are they hitting their KPIs? you need to make sure you're measuring the performance of the individual before they're going and, working from home. And are they excited to be working within the business? We're mortgage brokers. There's a lot of our business needs to be done face to face. When you're meeting with a business owner, who's got a $4-5 million portfolio, they're over calling the bank up and being 40 minutes on hold and not knowing who they're dealing with. A lot of people actually want to deal face to face, especially when it comes to the, bigger ticket clients as well, because they want to trust the person that they're working with. Me, I probably work from the office 2 days a week.
Yep.
There's a reason for that, because I'm out going and building business and building up partnerships.
Recording podcasts.
Yeah, recording podcasts. But other individuals, when you're first starting off and you're first in the business, you need to go through the training. And so our policy is ad hoc. It's not built in. It's not, this is it. But yeah, if you want to work in our business, expect 4 days a week in the office.
Look, I don't mean to go off topic, but I find it interesting. And every business is different. And I think you've worked out what's best for your business, and you find people.
But that's
who
by
will
trial and error as well.
Exactly. Yeah.
Yeah. If I didn't own property in the past, and I didn't have a line of credit where if I tried with someone and then they failed, that person easily could have cost me $30,000, okay, because of the trial and error aspect of it all. $30,000 on both how much their wage and their salary cost me, but on the other side of it, the opportunity that was lost by not making the other hire. So people always say, oh, no, you can just do this. If I didn't have my line of credit, if I didn't have my property in the past, if that didn't grow in value, guess what? My business would have failed. So you have to be very careful when it comes to that sort of
100%.
stuff too.
All right, I'm going to bring it back to topic, but I find it super interesting. So like I always say, I always go on a tangent if it's interesting. Let's then go back to the different types. Mm-hmm. All right, so we're talking office, we're talking retail, we're talking industrial, all different types. Yeah. Where are the opportunities for an investor, in your opinion?
There's
no financial advice.
different opportunities for different investors with different sort of risk appetites. You know what I mean? So it's kind of a broad question, but we are part of the Ray White Group, so we have some big commercial agents sitting on the same floor as us in the city. And one of the old experienced guys, I think last year he said all the money was in beds and sheds. So that sort of top end of the market, sort of like the big offshore money and the institutional capital.
Wait, so
it was all about beds. So it was hotels,
sheds is
industrial.
Okay,
yeah. So there was no love for office and no love for retail. However, that was last year, and I think maybe the next 12 months that could sort of pivot a little bit. I think we're actually seeing office sort of had bottomed out and it's coming back into favour. Again, as long as you sort of look at the quality assets with the strong fundamentals, I think there is sort of more positivity in the office space if you select the right assets.
Is that just when you say bottomed out and they come in favour? Is that just because all of a sudden if beds and sheds are growing, and office is not, then all of a sudden office becomes the affordable?
Yeah, absolutely. Well, not really affordable. It's just capital flows, right? So, the last couple of years, a lot of capital has been flowing into industrial and sort of hotel accommodation of various sort of substances, whether it's boarding house, service apartments, student accommodation, or your typical hotel accommodation. So a lot of capital did flow into those asset classes. But then, that kind of reaches a point where maybe it's not as attractive. So then the capital's looking for a different source. And then office could be more favourable because, there are some positivity sort of in the office market, more people back to the office, working in the city, incentives are dropping a little bit. All of a sudden, the entry price for office and those yields that you acquire the assets start to make sense again. And those risks have subsided somewhat. So it's just sort of the cycle of capital and what sort of it looks for at a certain point in time with some consideration to some macro sort of economic factors as well, Michael.
Makes sense. Yeah. Let's go back to industrial then.
Because you get the opportunistics and then you get the safe investor group. Opportunistics might predict that. People going back to the office, they'll get their higher yield. They might pay less for the asset. And then you've got the people that just want the secure asset that's performing at the time.
You'll be a lot smarter than me. This is interesting stuff. I like it.
I bet you're very smart.
Oh, I think I'm okay.
Your own regard.
Thank you, mate. I'm looking for compliments. That's all. That's why I do this.
I thought that was it.
Hannas.
Yep.
Let's talk about some of your projects. Let's unpack those a little bit. Let's see, what are you seeing on the ground and what's happening out at Brookvale, Northmead, Byron?
Yeah, Hannas has got an extensive background. Like we're 36 years in business. Started in infrastructure. We've had a crack at some residential in the CBD and the Rocks. We found that industrial was the asset we wanted to go with. The growth of it, the this unearthing of this great opportunity for investment and things like that. And we felt that development pipelines were probably behind where they needed to be to keep up with population growth and business growth. So we sort of, like I was saying before, much easier asset. You got the similar structure to residential towers, but much easier internal asset to maintain. A lot less in terms of defects and things like that. That can go wrong.
Also constructing as well, right, from start to finish. Like we like the equity and the debt positions with industrial strata because you might only be building for 12 to 18 months, whereas resi projects could be 24, 30 months, more trades, more construction risk, whereas industrial can be quite straightforward.
Yeah, because that fit out piece, you're going foundation, slab, precast, and then the fit outs are, like we're doing the fit outs at Brookie now and we're 3 months from completion. That's 34 warehouses and 50 storage units. So that fit out piece, on residential, that fit out piece could take another 12 months. Yeah,
I like the storage unit mix as well because they say, like, you hear about it. It's
well,
very
you went
affordable.
into one. Yeah.
I went into. I did what I did. It was very nice, and I'm like, you just start thinking about what you can store there. Obviously.
No one would have thought you could make storage unit sexy, but that one we took you through, surely
it was the sexiest storage unit I've seen. I'll be honest with you. But it's more affordable. Are people buying? Do business owners buy those to supplement the room, or is it like an investment thing, or like what are people using the storage units for?
Again, it's like a warehouse unit. It's an more affordable option of a warehouse unit where you're not paying for the office. So your businesses that are operating out of them or using them, you're not supposed to sort of operate full time out of them. Are your businesses that are more storage based? So a lot of trades.
Yep.
All the product, all the equipment goes in there. They shoot down there in the morning, load the van off the site, whatever they do. We've got small e-commerce groups in there.
I was going to say, small online business would like just leave your stuff there, go pick it up as needed, and
Because when you don't need the 40, 50 square metre office, which at say $8,000 a metre, that's like $400,000 just for the office component of the warehouse. You just want the warehouse. That's kind of where the storage units come in, because they're completely secure. There's CCTV throughout. They're a nice finished product, very sturdy. And then you've got I could go through a vast range of industries, at least from us at our Lane Cove project. But you've got, your trades, got some car detailers in there. You've got the privates that are storing anything. They're putting car hoists in there, putting some nice vintage cars in there. You got guys that are just putting their own sporting equipment. Document storage for law firms. It's anything. Picture anything that involves storage, less operational. Bam,
I love it because I like unpacking the buyer, because it's like someone can be listening to this and go, "Oh, I'm a lawyer who needs to store my documents.
Hold them for 10 years or whatever the rule is."
I can see me doing that. Yeah, it makes sense. So I love that. I love the like I said, I love that Composite and Hannas are working together. You can start with 10K and get into a commercial property now, which is fantastic. And you've heard it here first. There will be more projects coming on board, so keep a look out for that as well.
If we can find land, like industrial has gotten so competitive that the cost of land for these developments is through the roof. So that's driving these new rates because the land isn't softening. There's always a buyer for the land, whether it's an owner-occupier, large business, developer, or some sort of fund manager that wants a income producing asset. So we're if we can find that project, at the moment it's very competitive. That's what's driving the rates. The development just isn't getting off the ground. And we often look for new sites. We're finding that there's a lot of stuff coming back online, DA approved, because construction's gone up. So construction's controlling that feasibility as well, which just shows there's a real undersupply of industrial, but the demand's not really softening. There's always businesses that need the space, but not us as a business, but just industrial as a whole is struggling to keep up with what needs to be delivered to cater for the population and business.
It's like resi as well, right? There's not enough supply, too much demand, and then that we all know what happens.
And everyone loves it, like perfect recipe. It's like everyone thinks it's a bubble. It's gonna resi, but where are we all going to sleep? Where are people going to go? Tents and.
So I just do want to ask you a question. When you're looking to purchase a site, or you're going, the negotiation side, are you noticing a lot more competition because a lot of the resi developers have exited the market to enter the industrial side or the commercial development side?
Yeah, there's definitely, and Dan can probably comment on that. There's a lot of guys that have got no resume of industrial. I think it was called Level 33. I saw one down in your neck of the woods.
That was one of the guys that I had in the back of my mind, but I didn't want to name it on the podcast.
And there's all these other ones that are sort of used to be heavily residential based that are now just having a crack at industrial.
It's a simpler project to deliver fundamentally. Like the residential sort of build process is very arduous. Like you've got, basements, potential ground risk, you've got all the trades you have to coordinate, the cost escalation, you're exposed to construction risk for 2 to 3 years, whereas industrial can kind of get in and out a bit quicker. So I think to your point, Joe, we are seeing a lot of builders, for that matter, pivot away from residential to industrial or commercial, but also sort of developers as well. I think they just think it's just all too hard sometimes with residential.
Simple is good, in my opinion. So yeah, that's great. Good to get
not too simple. Still make sure you're creating a great product.
Of course.
And that was, I guess, in terms of our place in the market, it was like that's where we wanted to go. High finishes, cut no corners. Create a product that's superior, because if you're just going in there with the same product as the guy next to you and the other 5 guys down the road, you're gonna be in heavy competition. So you've got to create a product that's unique and something that people want and see value in, and the market might perceive as something that's going to grow.
Love it. We'll add some links in the show notes, and if anyone inquires, I'll probably speak to you. So that's
myself or Carla out the back.
Or Carla who's watching along. Yeah, lovely. Joe, someone wants to get into commercial. What do they need to do?
Am I doing shameless plugs here?
Yes, this is a shameless plug part of the podcast.
It's simple.com.au. You can click on the links at the top right. You can, you get a direct access to me where you can book on Calendly.
Yep.
I'm also always on LinkedIn, where I actually get a lot of people contacting me these days for these sorts of opportunities, like the ski lodge we were discussing earlier. Either LinkedIn or it's simple.com.au.
Amazing.
Thank you.
Dan.
Yes.
Plug whatever you want.
Well, we're part of Ray White Group, so everyone knows Ray White Group.
You got cash?
Yeah. We've got money, but
Capital
we're
they
just
wanna
a
deploy.
small business within the big sort of Ray White network, and we're very active. We've got appetite to lend on good quality commercial projects, industrial projects, and then also sort of participate in equity joint ventures with quality sponsors such as the Hannas Group. So
great.
We can be sort of something to everyone.
That's great. We position this pod for the buyer, the customer, but a lot of developers and builders
reach out.
And they make it easy because we sit in the same office, so they might come across a site, or we might come across a site, and then our COO and owners will walk straight across to see Dan Millar, and they'll start looking at the nitty gritty of it, and then they can give us a pretty quick answer whether what their lending might look like on it. So that's been a great relationship.
I love it. Yeah. All great guys in the room. I love this. Thanks
another
for
compliment.
Great chat. And we've probably, as always, we've gone over time because I'm just interested and I'm asking tangent questions.
Yeah.
I'm going to ask another tangent question. This is a question that has nothing to do, and then we're going to wrap up the pod. It's a question for you, Joe. It's got nothing to do with commercial. Today, legislation is in place for a 5% loan.
Man.
Tell me, I want your opinion on this because I'm seeing a lot of different reactions to it. Can you just explain what it is? We'll cut this up separately.
So they've essentially done is they've made changes to the first home guarantee.
Yep.
Previously, there were income limits, so you couldn't earn more than $125,000 as an individual, $200,000 as a couple. That is now scrapped. Previously, it had to be 2 people entering the transaction, so either yourself and your wife or yourself and a sibling to purchase a property. That has been scrapped. So now 4 of us buying our first home together, let's go do that. $10,000 each. Let's go get a $800,000 apartment, or something like that, because it's a net 5% deposit. And they will waive the LMI, or not waive it. The government will come in as the guarantor and guarantee that remaining 15% to the bank. My personal opinion on this is it's stupid. It's giving people false hope. It hasn't been clarified correctly. And I just do not think for one moment this is actually benefiting the Australian public, because all this is going to do is whoever was competing for the $800,000 properties, $900,000 properties, and they were in that $125,000, $200,000 mark with a 5% deposit, they're now going to get smashed out of the water by someone in the industry working a high-paying job, just saved 5%, doesn't own a home yet. Oh yeah, I'll just go to the auction and I'll just pick it up myself.
It does drive it up.
It's going to put a rocket in the market.
And is that who's that actually helping? The seller, I suppose. But I just look at like the cap is 1.5 mil. If I put down a 5% deposit, my mortgage is
You're trying to get me triggered now.
Yeah, what's my mortgage? 8K a month, 8.5K a month. Like,
all right.
it's ridiculous.
Sleeves are getting rolled up. All right, let's do this. All right,
I like
so if you're purchasing a $1.5 million property, you need a $75,000 deposit. So that's already 75K. The one thing that has not been clearly explained to people across the market is a first home guarantee and a stamp duty concession or the first home owner's grant are two completely different things. So in New South Wales, if you are purchasing your first home and it's up to $800,000, you will have a complete stamp duty concession. It'll be $0 for stamp duty. Between $800,000 and $1 million, you will receive a discount. So the closer you get to the million, it'll be about 25K. After you hit that $1 million, after you go over that $1 million purchase, you are paying the full amount for stamp duty.
Oh, the full amount. So
Yes.
it's not like a
No.
yeah, okay.
So it doesn't work the same as the other schemes in the market. So the issue at hand is you've got the Prime Minister going on Instagram and TikTok saying you could buy with just a 5% deposit. Yeah, up to $1.5 million. No. $1.425 million, meaning that you need a $250,000 household income to be able to afford that mortgage. You need $75,000 for the deposit, and you need $67,000 for your stamp duty. So we are falsely advertising this. And on top of that, we are giving false hope to a lot of people in the market that aren't going to be able to actually use this scheme. So when you ask me the question on the first home guarantee, I think it's a complete farce. The issue at hand is not the demand for property or the people wanting to get into the market, because we've already had that. The issue at hand was the supply. And if we've got so many regulations around housing, it's just going to drive the prices up because we have so many people coming in wanting to buy Australian homes. Yeah. Sorry. I'm sorry.
No,
I get visceral about that.
No, it's the same with industrial, same with residential. We've all got the same criteria to get in, to buy something, to develop. And at the moment, like he says, red tape, costs.
One more thing I do want to highlight, if it's okay.
Yeah.
So different from the first home owner's grant and the stamp duty concessions, you had to live in the property for 12 months,
yeah,
and then you could make it an investment afterwards. With the first home guarantee, so long as the government remains a guarantor on the property, you cannot make that property an investment property.
So does that mean you need to get to a certain equity level?
And then you need to do the internal refinance. You need to contact the bank and ask them to do an internal refinance and remove the government as a guarantor. So let's say the four of us got together, we purchased the property, okay? This is now an owner-occupied property for all four of us. So if we've got a two-bedder out in Randwick, okay, 800K, 10 grand, 10 grand, 10 grand.
On top of the bunk.
Dan's on the couch. Dan's got the fold out.
All four of us have to be on the council rates. All four of us have to be on the strata. What if one of us gets married? What if that person gets divorced? Does that mean that the person that's divorcing us is taking all four of us to family court and asking for half of that property now?
Complex now.
So it's creating issues in the market that don't need to exist.
I think you're right. And it's, they say, oh yeah, you can get in with 5% now. Sounds great, right? But yeah, we're fixing housing affordability. But there's so much more. And like PJ, clip that, send it to Joe, because more people need to know about the actual details. And yeah, sorry to go on a tangent.
No.
And I wish I started with that, because it fired you right up and it would have
reaction. I just there's so many issues with it, especially the fact that if you want to turn it into an investment property afterwards. You've got buyers agents out there saying, oh yeah, just turn it into an investment in 12 months. No, this is a different scheme. This is a federal scheme. The other one is a stamp duty concession. They're not talking to each other.
Yeah.
So you need to make sure you speak to a professional. I'm not even saying a broker. Speak to a lawyer before you go and engage with this scheme, because they will give you the correct advice in order to be able to, whether it's suitable for you or not. And that's why I'll tell you now, last month, great month, everything. We did 240 transactions in FY25. Of those, 3 were first-home buyers.
Oh.
The issue is not first-home buyers wanting to get into the market. First-home buyers want to get in. The issue, it was not the previous scheme. The issue at the moment is there's not enough supply in the market.
Yeah.
Sorry. Thank you.
Next episode, supply. We'll be back. But I appreciate that. And like I said, we'll cut that up. Total tangent. But gentlemen, thank you for being a part of Property Now with us. Everyone at home watching
cheers,
or
Cubs.
listening or in the car or what have you, we'll see you next
Cool
week.
with that now.
Appreciate it.
He, the sexiest voice in property, here to tell you that the Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only and general in nature. It does not take into account your objectives, financial situation or needs. It does not constitute professional advice. Always seek expert guidance before making any property related decisions.